Good evening to one and all present here. In today's event, we have with us our product manager, Jason D'Souza, who is back with episode 2 on how to select the best mutual fund. We'll also share how to rate a fund, the analysis currently provided by Markets Mojo, and it'll also show ways to compare two mutual funds. You can ask your queries in the Q&A session towards the end. Over to you, Jason.
A very warm welcome to each and every investor gathered here for today's event. In the first episode of our knowledge series, I spoke about what are the different types of mutual funds. If you remember, we spoke about equity mutual funds, debt mutual funds, and also a hybrid, which is a mix of both the approaches. Today's webinar will be slightly diving deeper. We'll be looking at how we can select the best mutual fund now that we know the different types of schemes available. Starting off with a disclaimer that investment in securities is subject to market risk. Past performance should not be construed as a guarantee for future returns. As I was speaking about our journey till now, the first was the different types of mutual fund schemes. Second, what we'll be covering today is how to select the best mutual fund. What is the analysis we offer as a retail investor, how you can actually look at a mutual fund scheme and decide, yes, this mutual fund should fit in my portfolio. And the third one, which should be much more interesting, is how we can create different type of mutual fund strategies, portfolios, switching across different schemes and the new features we'll be launching. So just for today, the second part, which is how we can select the best mutual fund, what is the analysis we are going to do today. Before I dive deep into how you can actually rate or understand how to analyze a mutual fund, let's look at something which goes right into the depth of it. Every mutual fund scheme which is released every mutual fund scheme which is available to invest in, you should understand that there are two different types when it comes to mutual fund schemes. I had previously covered this, but there is an active approach. Here in the active approach, the fund manager selects the securities to invest in, okay, and he expects to generate better return than the benchmark. Okay, so that is more of an active approach. This is not a passive approach, where in a passive approach, the mutual fund manager takes a step back. He simply thinks of mimicking the index. Okay, so if you're investing in a mutual fund and you want more returns than the benchmark, you would be looking at active mutual funds, which is where I'll be speaking most of my content today. Whereas a passive mutual fund is very simple. The goal is just to mimic the index. We won't dive deep into this, okay, because there's very less analysis you can actually do on a passive mutual fund rather than active mutual fund schemes. Also in today's webinar, I'll be diving more deep into equity ratings, okay. We'll not be talking much about debt ratings. They are available on the website. But today we'll be looking at how to actually rate equity mutual funds. So let's start off. The first thing is that we'll be looking at consistency with returns. Okay, I already spent a lot of time on this particular term of consistency, but we'll also dive deep into that. Okay, the risk taken to generate that returns. I'll be breaking down 2 or 3 simple formulas. And throughout our investment journey, a lot of investors actually speak about these ratios or formulas. But I will actually show you on a chart what exactly these mean. The portfolio strength or the portfolio composition bases the stocks held in that mutual fund schemes. We actually go and look into each mutual fund scheme and look at what are the stocks they are investing in. Okay. We'll also find out how to compare between two mutual funds and find out which is the best for us. Okay, there can be 2 buy-rated mutual funds, or let's say, 2 hold-rated mutual funds, whatever it is. But apart from the mutual fund rating system, let's look at how we can simply look at 2 different schemes and find out which mutual fund we should actually go ahead investing in. And lastly, which I've added by myself after speaking to the team, is a lump sum versus an SIP approach. What kind of approach you should follow when it comes to investing in mutual funds. So these are the 5 different things we'll be covering in the second episode. Starting off, fund consistency with returns. Okay, so within finding out which mutual fund is the best, we have to also understand what will we compare that with. Okay, if I simply come up today and tell you, what, Axis so-and-so mutual fund has given 30% return in 3 years, you can't actually reach to a point whether that fund has actually done well. So we'll be looking at 2 things, which is the benchmark and peer averages, which is the competition and the importance of being consistent and how it solves the problem of entering at any point of time. So in our mutual fund page, in the mutual fund analysis page, there's this particular card where we compare the 1-year return. Okay, so for example, this is JM Financial Large Cap Fund. Okay, The name being large cap, it invests in the top 100 companies. Okay, that's its index. So along with the fund's return, which is 7.81%, this is the benchmark, which is S&P BSE 100 TRI. TRI is nothing but total return index. Total return means it takes into consideration the capital appreciation as well as dividends of the stocks. Okay, so let's ignore this term for now, but this is the benchmark where the mutual fund manager will mostly look into picking up stocks from. And on the right side of it, we have peer average. Okay, peer average is nothing but the similar mutual fund schemes. What is the average performance of them? Now, most often we actually only look at either the benchmark or either the peer average. If you go to different websites, they only look at either one of them. Here, we need to ensure we're looking at both. We're looking at the benchmark. Okay, it can be BSE 100, BSE 500, so on and so forth, and also the peer average, because we're looking at how other mutual fund schemes in the category have actually done. Okay, so for example, this fund, okay, if you can see, it has outperformed the peer average. Within its peers, it's done better, but it has still not outperformed the benchmark. Okay, as an active fund, the first slide I showed you before that, active versus passive. As an active fund, if you are putting your money in an active fund, your goal should be to beat the benchmark as well as the peer average. Okay, if you're just selecting a passive fund, then you can just mimic the benchmark, so that's not much of a problem. But if you're investing in an active fund, your goal should be to beat both the benchmark and the peer average. Okay, this is very simple. You can actually get this data on the site. I'll also take you across that. Moving on, the importance of being consistent when selecting a mutual fund. I'm going to show you two different schemes in the multi-cap index, okay, the multi-cap segment. Now, what exactly is multi-cap? I already covered in the first episode. But if you look, there's Baroda BNP Paribas multi-cap fund, which has given a 1-year return of 8.18%. And another fund, which is Kotak Flexi Cap, which has given 12.61% return. Now, let's just pause here and look at the slide. If I give you an option to select the best fund within both of these, okay, the human mind would ideally go for the right one, which is nothing but Kotak Flexi Cap fund. Okay, and the reason is that we are only looking at one particular thing over here, which is 12.61% return, which is greater than 8.18% return. Okay, so just because this is particularly greater, we might actually look at investing in this particular fund. And that's a common mistake we always make as investors. Let's eliminate something known as recency bias. Okay, the term recency bias is nothing that we look at the recent performance and we reach to a conclusion. Let's eliminate that. How can we do that? Let's look at the consistency of this fund with the returns. So the first fund, BNP Paribas Multi-Cap Fund, if you see, this is the half-year periods of the fund. Okay, here we have the fund return and the benchmark return. Here we break down each of the half-yearly periods. So for example, September to March, it has outperformed. Okay, the previous, it has underperformed. Whereas if you look at Kotak Flexi Cap Fund, it has had multiple periods of underperformance. Even though it has done very well in the last 1 year, if you look at the underperformance, it's much more severe than this particular fund. So this fund has underperformed in 2 out of 4 instances, but this fund has underperformed in 4 out of 6 different instances. Okay, so you can see how consistent these two funds are, which is more consistent. Okay, that's the reason the 3-year return of this particular fund is much more higher at 77%, whereas the 3-year returns of this fund is only at 53%. Mainly because it has underperformed very severely in the previous periods. So let's not just stop at looking at one return field and say, you know what, ये mutual fund थोड़ा better लग रहा है. This thing doesn't make sense. As retail investors, we fall in this trap. Let's look at half-yearly periods and look at each of the periods. The reason I'm saying this is that you might enter at any point of time. Okay, so for example, you might not just enter over here at March. You might enter here as well. Okay, so for example, let's say you entered in March 2021, you're underperforming for 3 different periods consecutively. Whereas if you enter here, you'll underperform here, and finally you're outperforming when you don't have much, interest in that particular mutual fund scheme. The idea is that whenever you enter the mutual fund scheme, you should be outperforming every period then and thereafter. If there's a long period of underperformance, it will affect the returns over here, as you can see, 53%. Okay. Finally, if you look at the rating of the funds on our Markets Mojo page, even though the return for Kotak Flexi Cap is higher for 1 year, it's falling under the sell criteria. Whereas BNP Paribas is falling under the buy criteria. One of the main issues is simple consistency. The fund manager has the magic wand in his hand to pick the best stocks, okay, for that particular mutual fund. If he is not consistent with providing you returns, we would simply rate that mutual fund as sell as well. Okay. So consistency being important, that's it with the first part of this particular episode. Let's move on to the next one, which is the risk you take to get the returns which I showed in the previous slide. Now, what if I told you that, you know what, Kotak FlexiCap, which I showed you, was less riskier, whereas BNP Paribas was more riskier? It might change the entire narrative. We are always looking at returns when it comes to stocks. Okay, but when you look at mutual funds, we have to also look at the risk needed to generate returns. I tried explaining this last time as well, and I got a lot of feedback that, you know, all of this goes above. You know, this is very difficult to actually crack. But this is very important for us retail investors to understand these terms. If you're an experienced investor, you will understand the next few terms. But if you're new, you don't have to worry. I'm breaking it down to the most simplest point possible. Will my investments be highly volatile? I'm investing in a mutual fund. Do I have to be very worried with the volatility in that mutual fund scheme? Can the investment reduce to half of its value? This is a very important point. We invest in different schemes, or let's say a PMS house or any particular stock. We don't understand this particular thing, which is, can my investment, मैंने अगर 1 लाख रुपए डाला है, can that 1 lakh rupees become 50,000? Is there a possibility? Has it happened before? And the last one is that, are the returns worth the risk taken? Now, to understand these three different questions, what's the risk needed to generate returns? We have a few parameters, such as the first one is beta and volatility, which will help you explain how volatile your investments are. The second one is maximum drawdown, which will help you understand that, has this particular mutual fund actually dropped to half of its value before? And the last one, which is risk adjusted returns, which I've also explained previously. These three things on the website will help you understand the risk needed to generate returns. Let's start off straight with the first one on beta. So will my investment be, what exactly is this beta? We always refer to it, but what exactly it is. Let's take a simple graph. Okay. Down here we have the time period of how the mutual fund scheme trades over a period of time. And this is, let's say, the NAV of the mutual fund, nothing but the net asset value. Now look at this particular line over here, and we will consider this as the benchmark. You can expect this to be, let's say, Nifty 50 or Sensex. Okay, this is the benchmark of that fund, this black line. When we talk about a highly volatile fund, you can see how the chart moves. If you see, when the benchmark fell down over here, this particular highly volatile fund fell even more. When the fund went up, it went up higher. It went up higher than the curve, and again fell down, it fell down even more. This is an example of a highly volatile mutual fund scheme. That is, if the benchmark corrects a bit, the highly volatile scheme will correct even more. If the benchmark rises, it will rise faster. Whereas if you talk about a mutual fund with low volatility, it won't move as fast as the benchmark or a highly volatile scheme. Here, if you can see the NAV of the lower volatile mutual fund, as the benchmark fell this much, it did not fall that much. Okay, it is quite stable. And when it increased well, and it is trading kindly higher than the benchmark. Okay, but this is an example I want to give you. If you look at these three lines, you'll be able to understand what's the beta of the mutual fund, how risky it is for my investment. Okay. If you all have got this particular chart, let's move on to the next one, is that what exactly is this max drawdown and how it actually can affect my investment. The same chart again plotted NAV and time period. Okay. Now, if you see a particular, let's say this is a particular mutual fund scheme. Okay. This is how it's been moving. If you see this particular correction over here, the fund has fallen by 20%. It was over here. Okay. And it has fallen over here to its lowest point over here. Okay. The fund has fallen by minus 20%. But there's another instance where the fund falls by 50% of its value. This is your maximum drawdown. How much has the fund fallen the most in the previous period? Now you have to understand the importance of also timing over here, which is practically impossible. Where will you enter? Tell me, have you entered over here? If you have entered over here, then you're slightly at a safer place compared to you entering over here. If you enter over here, this is how much your investments can fall. And this is very important to understand because there are a lot of small, or let's say small companies who actually trade very volatile, and they actually face these drawdowns. So when you are investing in a small cap fund or even a mid cap or a large cap fund, maximum drawdown is one thing you will have to see to understand, can my investment reduce to half of its value or even more? This was just an example for you to understand this particular term. It won't happen with every mutual fund scheme, but it is possible. Okay, so we're done with 2 charts. Let's look at the next one, which is the third part of what's the portfolio composition. Now, if you know Markets Mojo, we've started off as a stock research analysis platform. We now have mutual fund as a feature on the website. But since we started as a stock research platform, we have a lot of analysis already running on stocks. We're already reviewing all 4,000 plus stocks and calculating the dots for that. So we also use portfolio composition. That means which stocks the mutual funds have invested in and try to understand how exactly that mutual fund scheme can perform. Okay, power of one to many, that's how I call it. Rating of stocks held by mutual fund schemes. Let me quickly take you on the website and show you how it exactly works. So for example, I'm going to go on this particular first scheme over here, which is IDBI 100 Top Equity Fund. Okay, it's ranked number 1 across large cap schemes. Okay. Now, as I scroll below, I want to break down the 3 different parts I explained to you. This was the first card I showed you. Now, if you see, this fund has outperformed Nifty 100 as well as the peer average. We can't just compare to one of it. Okay. And if you look at the consistency over here, you'll get a better idea. For 2 periods, it has underperformed. Okay. And the underperformance was not by a very big margin. But over the last 4 periods, it has been outperforming. Okay. So these are the 2 cards I covered on return. Okay. And risk. So this is the low beta. If you see the benchmark, it has a 17.05% volatility. This has 17.18. So in line with the benchmark, beta is low at 0.98. Okay, and lower drawdown. This was the chart I just explained to you over here. If you remember this 50% drawdown over here, this fund fell by 30%. But lower drawdown because the benchmark itself fell more by minus 32. Okay, so these were the 2 different things I explained. And the third one, which was portfolio composition. As I said, we started off as a stock research platform. If you click on any of these stocks over here, you will reach to that particular stocks page and get the score for that particular stock. But here you can see we dive deep into each of the stocks and how they've been rated, what's the weightage. So as I glance through this particular one, you can see the first dot is mostly green over here. I'm not finding any below average company. Okay, there is one below average company, which is DLF, another one Ashok Leyland. Okay, so here is where you can understand the overall rating of the particular mutual fund scheme, the stocks they hold. And this is much more simple, where you can understand which is the top sector the mutual fund is invested in. So for example, this particular scheme is highly allocated towards bank and private banking sector. And here we can see, since it's a large cap fund, 95% of its AUM is into large cap schemes, whereas 2% into mid cap or 1.82 into small and micro, so on and so forth. So this was the third part, which was the portfolio composition, the power of one to many. Okay, now since we understood the 3 different parameters we are using to rate these schemes, let's now go into a proper example, a practical, approach on how we can actually compare 2 schemes and see which one looks favorable for our investment. Okay, so coming to comparing 2 funds, I've picked up 2 ELSS schemes today. One is PPFS, Parag Parikh Tax Saver Fund, and the SBI Long Term Equity Fund. Now they are ELSS schemes. I just picked this particular category. There's no particular reason for it. Okay, but the one thing I'm doing here is I'm not doing a mistake of comparing a tax saver scheme to a small cap scheme, or comparing a mid cap fund to a large cap fund. When you're comparing a mutual fund, you have to understand it has to belong within the same category as well. We need an apple to apple comparison. So we need to look at them within the same scheme, because obviously a small cap will have higher risk versus a large cap, so on and so forth. But if we compare these 2, I've just taken a screenshot of the dashboard. Okay, you can see this is rank number 3, this is rank number 8. This is the dashboard I've been talking about. Okay, I've just put the screenshots over here. And there's one important learning I want you all to take away from this. Okay, if you look at this particular fund, it's new because it has only been for the last 3 years, and it has a smaller AUM. It's number 21 by size. Whereas if you look at this particular one, it looks very different. It's an older fund, 29 years with a larger AUM. Okay, now one of the funds over here has a particular advantage and one of the fund has an advantage. Okay. The advantage of the first one is the smaller AUM which I'm talking about. As the mutual fund scheme becomes big and big in nature, okay, it gets very difficult for the fund manager to face liquidity issues, especially if it's a small cap scheme. Okay, so if you're investing in, let's say, a small cap scheme and the AUM is very big, okay, there can be a problem for that mutual fund to actually accept more funds to come in. Because as soon as they get the more funds, they will buy their particular small cap stock they're investing in, and it'll be very difficult for them to handle the liquidity issues. So size of the AUM is one thing you can keep in mind, especially in small or mid-sized companies. And fund age is even more important because it takes some time for you to actually understand how long has that manager or that fund actually been trading in the mutual fund space. Older funds are ideally given more importance to because they have a track record. They have shown how much they can be, how have they been trading versus a scheme which is very new. If there's a new fund offer or something which has traded for only 1.5 years, there's not enough time to actually analyze that particular mutual fund scheme. Okay, so fund age and AUM size, these two things I wanted to touch upon. But let's now go into what we've learned today. Let's look at the returns first. If you look at the consistency pattern, this fund has underperformed for 2 periods and this fund has also underperformed for 2 periods. Okay, so it's an equal tie over here. There's no particular scheme which is showing more consistency. Okay, if you can see, they're both 4 out of 6 instances of being outperforming. But let's go to the next one, which is beta, which we just learned. How risky are the investments? If you see, the first one has 0.72, which is a low beta scheme, and the second one has 0.86. Okay, so this is kind of preferred more because the beta is lower at 0.72, whereas this is 0.86. The next one, which is volatility, nothing but standard deviation. I've not touched upon much on this, but if you see, it has to be kind of low, which is 13.41 over year and 15.87 over year. The lower the volatility, the better. Okay, so here as well, we can see this particular mutual fund scheme having an upper hand. Okay, if you see the benchmark, both have 16.93. Even though both have given low volatility than the benchmark, this one has actually given the most lowest. Okay, so when you look at risk, this particular fund looks less riskier for my portfolio. Moving to the next one, the drawdown which we were speaking about. Now, if you invested 1 lakh in PPFAS tax saver fund, there can be a possibility that that particular fund has fallen by 25%. The worst period return of this particular benchmark. So if you invest 1 lakh, you're left with 75,000. But this one is even more riskier because it's fallen by minus 31%. Even though both have fallen less than the benchmark, which is 33, this fund still looks safer for your investment. Okay. Lastly, if you want to actually combine both of them and make a proper, comparison as to how much return I get versus how much risk I'm taking for it, let's look at risk-adjusted returns. I've touched upon this before, but I will do it again so that you get, a better understanding of it. We looked at the returns, 3-year return of this particular fund, 25.62, and this particular fund was 20.46 annualized. How much risk I take or the volatility, if you look at this particular fund, it was 13.41 lower versus 15.87 for this SBI mutual fund. Risk-adjusted returns, which is nothing but the amount of returns I make divided by the risk I take to generate those returns. For example, in the PPFAS is 25.62 divided by 13.41, which is nothing but 1.91. I'm just dividing these two things over here. How much return I make versus how much risk I take. Whereas for SBI, it is slightly low. It's kind of lower at 1.29%. Okay, this also forms the basis for the Sharpe ratio. I won't dive into what's the Sharpe ratio. I'll do it in the next session. But if you look at simply the risk-adjusted returns, this is one parameter you can look at when you're selecting your mutual fund scheme. Is my mutual fund scheme giving higher return versus the risk I'm actually taking? Okay, 1.91, it's actually beating it in a much bigger margin versus 1.29 for SBI mutual fund. Okay, you can also go on the site and actually compare these mutual fund schemes. So you can simply search for the ELSS criteria. Okay, and here you can see the different mutual. So I had picked up this particular one. Okay, and if you don't have to actually do this calculation, it's all available over here. Okay, all the values, everything, all of it is available over here. So you don't have to actually dive deeper into it. But yeah, this is how you can actually compare two mutual funds. And lastly, looking at the portfolio strength. Now, when I say portfolio strength, I'm talking about the portfolio composition. If you look at this particular scheme over here, okay, and the other one I'm comparing it, I'll just open it on the next page so you get a better idea. Okay, let's look at the portfolio composition of both the funds. Okay, so I have both of them open over here, if you can see. Now, the first observation over here is that most of the stocks they've invested are good quality. The first dot is green versus the next one, which is a mix of good and average. If you open the full details for this particular fund, here you can see the first line itself has green dots. Okay, there's one yellow and no below average company. So over the long term, the funds have really good stocks invested in versus the other one, which has a mix of both yellow and green. I think it has some red below average funds as well. I'm just looking at the first dot over here, which is nothing but quality. Okay. Then the second rating, third, so on and so forth. So this is where you can also see things like the top sector, which I've already showed you before, which is IT software for this particular fund. Okay. Then it comes to finance, so on and so forth. And for this particular scheme, if you see over here, it's banks and private. And also the allocation over here. Okay, so on and so forth. So here you can actually compare the portfolio strength of the two different mutual fund schemes. So how we've looked at return and consistency, risk of that fund and risk adjusted returns, and also portfolio strength. So next time you're stuck with actually, finding out which mutual fund scheme you should look into, you can always look at the rating. We rate all the mutual fund schemes in the category. But if you want to dive in deeper, this is the best way to actually compare two funds within each category and then reach to a point, what, I'm going to go for this particular fund. I know I'm going to take less risk in this fund. The drawdown is lower, higher risk adjusted returns. The portfolio composition looks good. These are the factors we can use when selecting the best mutual fund to invest in. The last thing which I wanted to touch upon, and this is the reason for this, is that because a lot of investors actually ask this particular question. Even in the previous webinar, few of the investors have asked this particular question. And today I will show you all, when exactly you can use them in your investment journey. Let's take some examples. Let's look at market scenarios. Let's look at a bearish market. Now, this is a very simple calculation. Again, NAV and time, okay, these two axes, but a very simple calculation. Let's look at a bearish market trend. The mutual fund is dropping downwards. If you looked at a one-time lump sum investment, and let's say you entered at the NAV of 30, versus you go at an SIP approach where you buy once, 1/3 of your amount, second time and third time. Okay, you're distributing your amount into 3 different phases. In a bearish market, because the price is falling down, your NAV will be averaged. So for example, when you actually invested at 30, okay, you're invested of 30 NAV, the current NAV is 15, so you're at a loss of 50%. But in a bearish market, since you're putting an SIP at the lower periods as well, your average NAV is coming low at 25 and your loss is much better compared to a lump sum approach. So this is a bearish market trend where an SIP actually beats a lump sum approach. If you are expecting the market to actually fall down, that's when you can look at a tranche approach. But if you are convinced that this is a good structural bull run, let's look at a bullish market, for example. Okay, same chart flipped upwards. If you go for a one-time investment, let's say you're entering at the NAV of 15 versus an SIP approach, which is 15, then you're buying it higher at 18 and buying it higher at 22. Here the lump sum will have a higher gain of 67% versus an SIP approach which has a gain of 36%. Mostly because whenever you're looking at an SIP approach, here if you see you invested at 15 NAV, 18 NAV, 22, so your average is become higher at 18.3 versus simply going one shot at 15 and then holding it, because all your money is over here at a lower price and you're exiting at a higher price of 25. It depends on the market phase as well. If you're convinced that it's a bullish phase, it's a structural bull run for the next few years, you can simply push in your money at a one-shot lump sum approach rather than doing an SIP one. Okay, so when you should take this decision is also depends on how the market actually moves. Do you have a sense of how the market will unfold over the next few months? Even if you ask me, I will say I don't have an idea. I don't have an idea whether we are moving in a narrow range. Will it be bearish? Will it be bullish? I do follow the SIP approach, But I look at more of lump sum investment because I'm a bit, not actually convinced where the market will move, and I don't think I can time it. Okay, so I normally use a mixture of both. I don't have a straight answer of this. But let's look at other questions. Is your income consistent in nature? Is it a salary-based income or is it a business income? Because these things will also influence you when it comes to investment. If it's salary, the most common approach is of using an SIP-based investment. You're receiving your salary on the first of every month. You know you have to invest in the equity market. You're going for a straightforward SIP. Whereas if you're a business person, you might, receive your profits every 3-6 months, not receive your profits in a 1 year. Receive it a bumper profit the next 1 year. Your profit or your income can be, volatile in nature. So your income, your method of how your income come also influences you how you can invest. Okay, is the investment amount substantial? Now here you'll have to understand one particular thing. Let's say your portfolio is of 1 lakh. And the next particular investment you do of, let's say, is 80,000. Okay, so here your actual next investment can be really big in nature. Okay, do you have to actually look at an SIP approach then? Or should you look at a lump sum approach here? Now there are mixed schools of thoughts over here. Okay, but if you're actually having a big amount coming into your investment journey, you can actually tranche it. You can say, let me invest 20,000 today, 20,000 again, 20,000 now, and the next 4 months, so on and so forth. Because that big investment will completely move the average of your portfolio. So your investment amount also depends on what strategy you can actually follow. Do you invest on a regular basis? If the answer is no, please go for an SIP approach. Please understand SIP gets in discipline. You won't actually look at your phone and say, I'm going to invest today. And I've seen very few individuals who are very disciplined with investment. Invest karna hai na, kal karta hu. Okay, I'll do it after a week. I've just got my salary. If you feel you're not consistent in nature, please go for an SIP approach. Don't sit and then time the market. Okay, I've got my salary, but I'll invest on 15th. Because I know the market will fall on 15th. If you're not on a regular basis, simply go for an SIP approach. Okay, and the most important thing is which asset class are you looking to invest in? Please understand that these market movements are much more fluctuating or volatile with the equity market segment. In debt, it's kind of not that prominent. You can invest in debt at regular intervals at any point of time or go for a lump sum approach. Okay, so which asset class are you investing in? Are you looking at a sectoral index? If it's a sectoral index, your timing has to be very important. You're betting on a sector. Okay, so you might go on a one-shot lump sum approach. But are you going for a debt, a dynamic bond debt fund? In that case, the NAV won't fluctuate that much. You can simply go for a lump sum approach. So which asset class is also very important to consider with a lump sum or an SIP approach? The best way to do this, if you ask me, is that it's not lump sum or SIP, it's lump sum and SIP approach. This is where I'll be talking in the next session as well of how you can make a big investment and then do an SIP approach going forward, or start off with an SIP and then when you should actually bulk in your investments. For me, it was never a lump sum versus SIP or lump sum or SIP. It has always been lump sum and SIP approach. And if you know how to crack this, of how to allocate your funds at the right point of time, there's nothing going to stop you from achieving multi-fold returns when it comes to investing in mutual funds. The 3 different things we'll be covering up, I've done with the first 2. The next one will be kind of much more interesting. Today's was kind of basic, but the next one will be much more interesting and a much more complex in nature. We'll be looking at STP plans basis market cycles. So, systematic transfer on how to transfer from debt into the asset class of equity, or how to take your investments from equity to gold, so on and so forth. Creating a portfolio of mutual funds. Okay, I'll also be helping you out, if you have 1 lakh to invest in, how you can break that 1 lakh. So many of you all might be, sitting on the border, not ready to invest in. My next episode will actually speak about that particular thing. Okay, and the new features coming soon in the mutual fund platform. We are actively working on this. So all the new features coming in soon, I'll be talking about that in the next episode. And before the next episode, the next topic on Saturday itself, with the financial year end coming soon, many of us, especially the salaried individuals, are looking for tax saving. I'll be spending my time this Saturday, 11th March at 7 p.m. I'll be taking you across what are ELSS schemes, what are they made up of, how you can actually select the best one, and how to actually plan your taxes, basically investing in ELSS schemes. So these are the next topics coming up in our mutual fund journey. Before I end the event and open the floor for the Q&A session, we do have an offer of 26 for 2 years plus 3 months. You can get free mutual fund transactions and 3 months only because you're a webinar attendee. And let's open the floor for Q&A session, Ritian.
The first question is from Mr. Jignesh. How can we use the trainer ratio for analysis?
Yeah, you can use the trainer ratio as well. So the risk adjusted returns I spoke about, which was the portfolio returns and divided by the volatility. Trainer just looks at beta. So you divide the portfolio return with beta and you minus the risk free rate. We will dive much more deeper on these ratios in the third episode. I didn't want to, so I believe in not overloading you all with information. If I don't know if many of you all know, the human mind has an attention span of, 20 minutes. And if I'm speaking for 30 minutes and I'm going to throw you with different ratios, it's going to be a bit difficult. But how we can use the trainer ratio, it's very simple. Use it along the lines of risk adjusted returns. You simply divide the portfolio returns with beta this time, not the volatility. And then the one which is the higher trainer ratio is always better. So you can also use that. It's available on some sites. I don't think it's available on Markets Mojo currently, but we can look up on adding this particular analysis as well.
The next question is from Mr. Abner Diaz. When can we introduce the score logic in mutual fund?
So score logic in mutual fund scheme. So we have a rating logic over here. Here we don't have a score logic. So if you look at the score part of Markets Mojo, we have 90 or 70, 60, 50, so on and so forth. Here we rate the different mutual funds. And then we say, you know what, the top 3 can be buy, hold and sell. So we won't have a score based rating. It's purely a rating based on the scale. It's an ordinal scale. So we won't be introducing a score logic over here in mutual funds.
The next question is from Mr. Elias. Is one mutual fund in portfolio a good approach?
No, I think it's a very poor approach. I'll tell you why. Which mutual fund scheme are you going to select? Okay, so one particular, let's say you want to invest on only one mutual fund and you want to get the best of all, large cap schemes, mid cap and small cap. That's when you can look at a multi-cap approach. Okay, so a multi-cap scheme, obviously invests in large cap companies in a certain proportion, mid cap and small cap. Okay, and the manager tries to, bet its money on the best segment which can do well. But still, even with that equity exposure, you will have to have some debt exposure. You will have to have some exposure to gold and silver classes. One mutual fund approach is very risky. It's not something I know, because your goal over here is to make good returns in the market. You should make returns in bullish phases of the equity market and bearish phases. But if you don't have a well diversified approach of having, let's say, a multi-cap scheme, some amount in gold, some amount in fixed incomes, some short-term liquid schemes, so on and so forth, that's when a good mutual fund portfolio can be created. Simply one mutual fund, I would suggest you not to do it. It will be risky.
The next question is from Mr. Sundar Raju. Dear sir, I missed your previous MF presentation. Will you guide me on where to watch previous presentation?
They are available on the YouTube website. Even if you go to, for example, you simply go to fundamentals. If you just share my screen and go to webinar, best of webinars, here we have the latest mutual funds, the webinars done. Okay. What I'll do is it's also available on YouTube. I'll make a playlist on YouTube as well, so that in case you can't find them on the site, I'll create a different playlist and we'll share those playlists with you so that you can also look at the first part. The first part was the categories. If you've come straight to the second episode, you might, kind of miss a lot of the first part as well. So do watch the first episode as well. I'll keep them available on YouTube.
The next question is from Mr. Dinesh. What is the benefit of selecting SIP weekly versus monthly?
There's no clear-cut benefit. There is a weekly, daily option as well, but I don't see a clear-cut benefit over here. Like, are you expecting the market to fall week on week? If that is the case, then you can go for an SIP weekly approach. But if you're expecting the market to, not, I don't think there's much of a differentiating thing over here. It totally depends. Are you receiving a particular income on a weekly basis that you want to invest? It totally depends on that, sir. But if you ask me, since I'm looking at a long-term lens, I'm not looking at a very short-term period, it won't have much difference in your particular mutual fund investments.
The next question is from Mr. Shivendra. I want to invest lump sum 10 lakh and I need regular monthly income without any volatility. Can this be done, Jason?
Okay, so you want to invest lump sum 10 lakh and I need regular monthly income. Great. And without any volatility. So without any volatility, it's not possible. But what you can do, since your risk is towards that, is very simple. I've also covered this in the first episode. You want to invest 10 lakh lump sum? Great. You want regular monthly income, then you have to look at an income-based fund. You will, when you go and you type a mutual fund scheme, you'll always find growth and you'll find IDCW, which was nothing but the dividend option before. You'll have to select that particular mutual fund scheme. Since you're looking for regular income, you'll invest that 10 lakh and that mutual fund scheme will give you the dividend back. So you're getting your regular income there. Okay. Without any volatility, it's not possible. So what you should do is very simple. Go over here to mutual funds. Okay. So for example, any particular fund you're actually looking at. Okay, so you can look at any particular income-based fund, but for now, I'll just select an equity one just to show you. If you want low volatility, so simply go to risk. Okay, there's not enough data in this one. I'll just select the next one. Okay, so for example, here if you see this has 21% volatility, which is higher than the benchmark over here. So this number should be low, so if you want low volatility, but zero volatility is not possible, sir. When we talk about zero volatility, you will have to have a long and short position, which is not actually available in, it's a derivative part of mutual funds. You will not get that. It's very difficult to, replicate a zero volatility mutual fund, but zero volatility is not possible. Look at a mutual fund with an dividend option, which is ICDW. There's a particular option which comes. Invest in that one so you get your regular income, and you can then look at volatility as well.
The next question is from Mr. Tapan K. Datta. Please advise the best ETF Nifty index fund where we can invest on a monthly basis for a long term.
Okay, so the best ETF. So ETFs, when you actually look at ETFs, they are actually looked upon in a different way. Okay, for example, if you could just share my screen. Okay, now I am on the Nifty Next 50. Okay, so Nifty Next 50 index fund, and okay, so ETFs, are actually looked upon in a very different way. I'll just search if I can get one particular ETF. Okay, so you have to actually understand the ETF approach. The first slide I showed you, which was active versus passive. The ETF is a passive approach, sir. When you invest in an ETF, your goal should be to get as much return and as much volatility that the index is giving. If I just show you my first particular slide, which I actually covered up. Okay, so remember I showed you this particular one in the starting of it, because I want to actually clear out this particular point, active versus passive. A ETF is a passive approach, sir. The goal is to simply mimic the index. So here you have to look at not the scheme which is giving the highest return in an ETF. So for example, you can look at 10.25 HDFC Nifty 50. Aditya Birla has given more return. But we are looking at the fund which is mimicking the benchmark exactly. So to select the best ETF, you have to look at the one which is given returns very close to the benchmark and volatility very close to the benchmark. Okay. So for example, if the fund return is 18.4, the benchmark return also should be 18.4. If the risk is 16.85, this is 17.01, so it's low volatility in the index. Here you can actually use the rating over here. So HDFC Nifty 50 ETF is currently the best one. So the best one, you can also look at the rating over here. But remember, don't look at an ETF which is giving higher return. That's not your purpose to invest in an ETF. Look at the one which has lowest tracking error, and that's when you can actually select the best one. On our side, currently HDFC Nifty 50 ETF is a good ETF scheme, the best one, best rated ETF scheme to invest in.
The next question is from Mr. Ranjan. What is the correct way to evaluate a mutual fund, and how can we compare multiple mutual fund plans to find out the correct choice?
So currently, what I showed on my PPT was compare one fund with the other one. Okay, I didn't actually speak about comparing multiple mutual fund schemes. But if you go on the website over here, okay, if you just share my screen. Okay, compare return with peers. This is one place where you can compare the return of all the indices. Now, as I said, return is not a very good approach to actually look at, this is not the one particular screen you can look at and then say, what, these funds are good, so on and so forth. But if you want to look at multiple schemes, so the best way is to simply go by the rating over here. We are also looking at analysis of mutual funds. Shortly, we'll be releasing that, where you can look at peer comparison as well. If you look at the peer comparison, the stock page, it's much more powerful. So for example, if I had to compare stocks, I can go much in depth with the mojo dots or look at quality or look at many other things. On mutual fund currently it's not there with multiple stocks, so on and so forth, but we'll be soon releasing these as well, sir, for your analysis.
The next question is from Mr. Sanjay. What is the difference between flexi and multi-cap fund, and which funds are good for better returns, either small, mid-cap versus large cap?
Okay, so small, mid-cap versus large cap, I answer the second part of it first. Yeah, I think my site's not loading. Just 1 second. Okay, so if you just flash the screen once again. Yeah, so you're between small, flash the question as well if I can just read it. Okay, so I'll just answer the second part first. So better returns, or it totally depends. Ideally small cap funds are poised to give better returns because they're investing in riskier stocks, sir. With mid cap ones, it's slightly less riskier, and large cap would give you least returns. But it totally depends on the business, on how the market is moving. So for example, last day, if you'll see Sensex and Nifty outperform the mid cap and small cap index, you will have to have a vision with respect to, what particular market cap will be doing well. And according to that, you'll have to actually put in, each of, which category you want. A better way to this is actually looking at a flexi or a multi-cap approach. Okay. And the main difference between flexi and multi-cap, I'm not really sure about it to the point, but I think the fund manager has some, leeway when it comes to selecting the market cap of these particular schemes. So I think multi-cap, the fund manager can actually, select its own large, mid and small cap proportion. With flexi cap, it has to follow a certain particular proportion. I don't know the exact difference, but I'll surely read upon it and, come in the next segment and speak to you on it.
The next question is from Mr. Nitin. How many years should we consider for consistency? 3 years, 5 years or 7 years?
I think 3 years is a good period. So I don't look at very long periods to actually look at consistency of returns. And the reason for that is very simple. What happened 7 years ago, or let's say 10 years ago, that particular period was very different. There might be a very different fund manager as well. And it's a very long period. So I look at 3 and 5 years. 3 years is a good period as well. Don't look at 1 year because it's quite small. So 3 and 5 years is a good period. I intentionally ignore 7-year period because what happened at that particular time of the market, what that particular, dynamics of the market are quite different what happens today. So 3 year and 5 years is a good period, sir.
The next question is from Mr. Sunil Gupta. It's a question regarding the ranking of scheme. QnA Robeco, small cap fund, ranked number 1 by Mojo. But there are many other schemes with lower ranking with much higher returns like HDFC small cap, Quant small cap compared to QnA Robeco. Can you please explain?
Definitely agree. That's why my first slide was actually on that. If you share my screen. Yeah. So here if you see QnA Robeco small cap fund has a 9.91% return. Okay. And you are asking me if the next ones have better return. So let's see which are the next ones. So again, I'll open QnA Robeco over here on one page. And then there are other ones. Okay. There's a sell rated fund which has much better return. So I'll open this one as well. Now, apart from the last 1 year return, which is the recency bias you see, you'll have to also look at different periods as well before that to get a better idea. So for example, this particular fund has given 15.11% return. Okay. Okay, so for example, look at over here. 1 year is 9.91%, but 2 years is 26.75, 3 years is 35.36, which is much higher than these ones, which is only 18.95. So you're looking at 1 year and you're saying, what, QnA Robeco, how is it? So that is recency bias. That's something we try to ignore. Okay, now let's look at the risk. For example, this fund has higher volatility than this peer group of 16.40. Okay, and then I'm thinking I'm a bit confused over here. Yeah, this has slightly lower volatility. Okay, then we can also look at the risk adjusted returns here, which is 2.05 over here. Okay, I think it's not calculated for this one. So, but apart from this 1 year return of 9.9% and this particular thing of 15.11%, we are looking at the return across different periods. Secondly, we are also looking at the portfolio composition, sir. So what you're looking at today is the past 1 year return, which might be lower than the particular other schemes available. But we are looking at the stocks as well. Are they good quality today? Is the potential looking better for those particular stocks as well? So I know I see a lot of investors writing back that this scheme has, lower return than the one which is sell rated. Then why are you, suggesting to buy this one? It's because we look at the potential going forward as well. Can the scheme do well? Okay, based on its outperformance and not just simply the 1 year return.
The next question is from Mr. Ghosh. Which is the best liquid term in terms of safety and returns?
So liquid funds are actually very safe, sir. I mean, it's like with stocks, we can get to this debate or, which stock is much safer or which mutual fund equity scheme is much safer. Liquid funds are kind of really safe. So there's very less, since they invest in very short-term debt securities, there's not much of a problem of, safety over here. The one thing when people invest in liquid funds, you should look at how fast you can get your money back. Because, many people invest in liquid funds to keep it as an emergency fund. So when you're investing in a very short-term liquid-based debt scheme, your goal should not be of safety. They are very low. They're actually quite safe. Your goal should be more on how fast I can remove my money in and put it back in that particular scheme. Okay. With respect to return also, there's a very minor difference. If you look at the debt, so if I'll just go to research any mutual fund. Okay, and here I'll just select debt. Okay, so if you let's say for example this particular gilt fund over here or this overnight fund, these are all very liquid in nature. Okay, but any of them ideally instead of just looking at the 1 year return over the longer period, it will actually average out. But you should actually look at how fast you can invest in that fund, remove your money, so on and so forth. What's the period of time, so on and that. So that would be a better way. Looking at simply risk is not much of a thing, and there is a rating available on the website as well if you want to actually see which of the debt schemes I can actually go and rush for.
The next question is from Mr. Hemal. I have a mutual fund portfolio of 40 lakh. Any suggestions on how to revamp it? Most as parameter mojo are hold or a sell. Any tax implication that I should be aware of or any take advantage of?
So I'll have to actually see your mutual fund portfolio. I can't, if it's hold and sell rated, then you might have to do a particular churn over here. Whereas, you will have to look at each of the categories, which of them are hold and sell, and how you can take that money into push into buy rated. In my next webinar of how to create mutual fund portfolios, I'll be able to actually cover this up in a much better manner. But a 40 lakh mutual fund portfolio is a substantial amount. You'll have to also see whether those schemes are you're investing in have they underperformed significantly. If yes, you should simply go and liquidate that scheme in that category and look at a better scheme, a high rated scheme in that particular category. But I won't be able to give you a straight answer, sir, over here. Tax implication that I should aware of or take advantage of is also depends on your income and your tax slab, sir. So I won't be able to give you a straight up answer on this. Okay.
Jason, we are done with the Q&A.
Yeah, thanks a lot, Adrian. I like the questions which have come, which are slightly varied this time. And looking forward for the third episode as well, where I'll be looking at a bit more in complex. This particular event was much more simple in nature. It was a very straightforward risk and ranking webinar. But over the next one, which will be slightly in depth, if you all have missed the previous events, I will put them on the YouTube channel so that you all can go and watch them again. Tomorrow we are releasing our stock of the month for March 23. All our Mojo Professional members will be getting an invite shortly for the same. Thank you all for coming for this event. Goodbye and have a great evening.